Hello and welcome to Commodity Champions. I'm Manisha Gupta. The global economic uncertainty may have the markets in mayhem, but commodities are in a sweet spot. Despite concerns of a slowdown and a softer dollar index, prices remain on a strong footing. This can be attributed to strong supply and demand fundamentals, and experts say that strong trade data from China will only boost the market sentiment further. This is particularly true in metal prices, which experts say have bottomed out and are on the cusp of a rebound. Copper has already begun that rebound after 3 straight weeks of a decline. Lower inventories and production stopped the metal's decline, with the same factors likely to keep prices higher going forward. However, no metal has shone brighter than gold. The yellow metal hit record highs in India last week and is still holding above $2,000 per ounce globally. However, this volatility has led to a decline in demand for gold and jewelry in India. So how much further will gold prices rise and what lies in store for commodities going forward? Joining me now to discuss that and more is Edward Morse, Managing Director and Global Head of Commodities Research at Citi. Ed, hi, thank you so much for joining us. First and foremost, reaction to what the US Fed has done and said in sense of rate hikes. Are you anticipating another rate hike or a pause? And what's your sense on the language that was used?
So our sense on the language that was used is to not know whether to expect another rate hike or a pause, but a pause is certainly now much more in play than it was a couple of days ago. I think it depends on where the data go, and we're waiting on that. The data have been deteriorating, so maybe that pause will be extended a bit.
All right. And are you at all surprised the way the gold prices have reacted, even if briefly hitting an all-time highs in the global markets and then, of course, coming off sometime? There is definite traction to gold, and we have seen all declines in being bought into. How are you looking at the prices from here?
So the gold prices are really in anticipation of what's going to happen to interest rates and what's going to happen to the US dollar. So it's a precursor to what is believed will be coming. The flows have not been as vibrant as you might think. So when we see a move one way or the other, it's because the liquidity in the market in terms of moving in and moving out is not great. Central banks have been a little bit on pause in terms of buying gold, and we're nowhere near where the open interest was a couple of years ago. So it's an anticipatory move. Very much so, and clearly there could well be a lot of money to be made. On the other hand, we've got to remember that it is based on what the value of the dollar is portrayed to be, and we don't know what that's going to be until we get to next year.
All right. Exciting for sure, and a lot of money being made, as you said, Ed. But any numbers that you're putting on gold? Are you looking at more all-time highs? Any targets on the higher side?
Oh, yeah, we certainly are. We think it could go to over $2,400 an ounce, and our probability on that is fairly high. So, yeah, we remain bullish gold, but we have to remind investors that this is a choppy road, and they need patience.
And are you equally bullish on silver? Because for a very long time, the silver price has continued to meander around that $25 per ounce mark. But we've seen 26, and the markets are anticipating 27, 28. What's your sense?
So we're seeing demand being strong. We think silver has another 10 to 15% upside to it, it's not the first choice for investors and against gold, but we do definitely think that there's room for upside. With that upside, however, we have much more upside in gold, so we think the ratio between gold and silver is likely to widen over time.
All right. So between gold and silver, while gold is your top bet, but in other precious metals also, we've seen platinum, palladium see some support also. There has been good buying here. The numbers also stack up on the positive side when you look at fundamentals in sense of supply and demand. Between all of this, are you picking up something?
Yeah, so we're basically still bearish on palladium. We think these are kind of short-term noisy movements that we're seeing in the market, but definitely we think the turning point has finally come on palladium demand. There are supply issues that can affect it from time to time. So we were keeping up our more bullish view on platinum and palladium, but at the moment we're neutral to bullish on both. In terms of other metals, We continue to see that problems within China in terms of hydroelectric power will continue to curtail aluminum supply. The curtailment is lasting longer than we thought. The weather has not been behaving. There should be a change in weather conditions by the summer to bring some relief there. On the other hand, the China story gets very complicated with metals because we've had an inventory situation that allows for enough inventory to be drawn down. On the other hand, the future looks particularly bright for some metals. We are in the longer term extremely bullish copper. We don't know where copper prices could go, but our estimate for 2025 is in the $12,000 per ton range, which is significant upside from under 8,500 right now. The upside in others depends on where you're looking. Lithium is another area where we think there could be 100% upside this year. On the other hand, what happens in the year after that and the year after that is a function of a combination of technology and lithium supply development. There's no doubt that there is significant supply potentially available for lithium, particularly in the so-called Latin American triangle involving Argentina, Chile, and Bolivia. Lots of potential development, but lots of political obstacles. And the same is true on copper. So while we see upside from copper on the demand side, the real issue is going to be, are there going to be significant blockages on the supply side rather than the demand side? And then again, we've got to turn toward that Latin American set of countries, among others, in order for Chile to continue to keep its percentage share of the global market, which is critical to where the prices are going to go. We need to have some clarity in what government planning is and whether the government's plan to keep a very strong national hand in the mining side and even to strengthen it by effectively nationalizing the lithium industry remains a large concern. So there are significant concerns on base metals mining. There's concern, obviously, on cobalt because of its concentration in an area where social issues are not very positive in terms of international investment. But a world that is going through an energy transition to reducing significantly carbon uses in the world and fossil fuel uses in the world, you can't get there without a significant increase in both battery supply, battery technology, the metals that go into battery makeup. They may be changing over time, but it remains a fairly bullish story for the next decade.
All right. So, yeah, well, yes, a lot of stuff happening in mining and smelting there. But I get your point that 100% upside on lithium from here, and copper could make all-time highs in 2025. But when we talk about metals, there has been an underperformance that we've seen in zinc, for example. The ferrous metals like steel and iron ore have simply been collapsing. A double-digit percentage decline in the last 1 month for both of these. How are you looking at the price coming back? How are you looking at the Chinese factor as well? Because there the fundamentals don't seem so supportive.
Well, on iron ore, there is a fundamentals element to it because China did start importing iron ore again from Australia. There is abundance on the supply side, and the drop was bound to come. We had thought it was going to come in the second half of the year rather than in the first quarter of the year leading into the second quarter, and we had to revise that forecast down. But we were fairly confident on where both steel and iron ore were going. On zinc, it's partly a function of what the inventory situation is, and partly a function of what industrial recovery is around the world, including China. We know that zinc in Europe has not been strong on the supply side, nor on the demand side. And in China, we have a negative PMI for the last month. We don't really know whether what we've seen in China is I was going to say optical illusion, but just a function of reopening and people being happy to get out of the street, people happy to move around, people happy to spend money for the time being. But the property sector is seeing very limited glimpses of improvement. There's a big supply still available in the market. There are financial conditions that are worrisome. The unemployment situation of youth grew to 20%. At a time when we thought the economy might be booming. So we don't know whether there's going to be momentum continuing into the second half of the year. If there is a stall out, then everybody's judgment on demand growth for commodities in China will have to be revised, whether you're looking at oil or aluminum or copper or anything else.
All right, get that. Another point that I want to talk about to you, Ed, is the de-dollarization, because many of these commodities, most of them actually are dollar denominated. They are put out in dollars as well. So with this big concept, while it is being talked, what is your sense on what is happening on ground?
Well, we've had some movement in it, and the movement has been high in percentage terms this year. But we also think it's limited. It's a very difficult thing to do. There has been an erosion of the dollar in some places and a growth of its utility in other places. I know if we talk about your country, there was talk today about what is Russia going to do with all of the currency is getting paid by buyers of their crude from your country and your local currency, and they don't know what to do with it in terms of what they may be purchasing. China is in a position where it's taking advantage of a situation in which it is seeing growth in its trade relations with certain countries that are using renminbi as a payment source. On the other hand, the government has been relatively insecure about allowing the currency to become a fully utilized international reserve as well as transaction currency. If they do that, they are concerned significantly about capital flight, and we don't think they're going to move very fast, very far, much above where they're going. So I'd say, yeah, de-dollarization is something that has gone up with the sanctions that the G7 countries, including the US, have imposed, particularly on Russia. It's been worried about in terms of where US-China economic and political relations are going. But meanwhile, it's very difficult to move to a world which doesn't have a widely reliable, usable reserve and transaction currency, and the dollar, the euro, basically stand out in terms of the scope of global trade coming from the 2 out of the 3 largest economies in the world. And China will find itself in a difficult situation, trying to undo all of its own entanglement with the US dollar. So yes, a little bit of erosion, but we think exaggerated at the end of the day.
All right. So my final question to you, Ed, is on the agriculture commodities, where we also are looking at very volatile moves coming in, and there is some support and buying coming back as well. And there are 2 things talked about here. One is the food inflation, and the other is the greed inflation. Is there something that catches your eye within the space?
So basically, we think that the volatility we've seen recently on the grains is related to concerns about what Russia might do on Black Sea passage of row crops, corn and wheat in particular, through the Black Sea to their customers. Russia's in a bind on this. Certainly, it is in conflict with the Ukraine, but it also tries to be a supporter of countries that are friendly to it, and those countries are recipients of row crops and oils coming out of Russia as well as Ukraine. They're sensitive to their market across North Africa, across the Middle East, and into South Asia. The rest of the world looks like it's having a significant sowing season for row crops. and the yields look to be promising, given where weather conditions have been so far. The Brazilian yields have been quite high. So we're basically seeing row crops, at least, as playing a continuing role in disinflation, the same kind of role being played by fuel prices in a deflationary environment. Now, I say that knowing that it depends on where a currency may sit vis-a-vis hard currencies, but by and large, we expect the row crops to be and the grains to be benign. We are concerned about soft commodities, and I put sugar and cotton at the top of that list of concerns. There are countries very familiar to you that put limitations on exports when it suits them, and that limits the amount of crop availability around the world. So for softs, we do remain on the neutral to bullish side, particularly when it comes to coffee to more of a degree than for others.
All right, that's a long list of agricultural commodities to watch out for, but major concern, as Ed says, is in case of sugar and cotton. Ed, as always, a pleasure talking to you. Thank you so much for joining us on CNBC TV18. With that, it's time for a short break, but coming up, we will take stock of silver's demand scenario, supply chain concerns and outlook going forward with Michael DiRienzo of the Silver Institute on the other side. Welcome back, and silver has been shining this year with prices rising 7% already in this year alone. This has come on the back of low inventories with COMEX and the London Bullion Market Association. However, the rise in price has experts worried about a dip in demand. Remember, India imported a record amount of silver last year, with many more buying the metal as a form of investment, jewelry or even silverware. So how far will silver prices rise this year, and what lies ahead in store for the metal? For those questions, I am now joined by Michael DiRienzo. He's Executive Director of the Silver Institute. Michael, hi, thank you so much for joining us. And what a last year, and the way the first quarter of this year also has panned out has been quite on the stronger side. We have seen very strong gains continue in case of silver. What's your sense on, first of all, the prices going forward?
Well, in terms of the price, I think the price has a lot more room to run. Okay, so the average this year so far If you go through today from the January, it's about $23.13. And that's up on last year's average. So the price is performing okay. We think there's a lot more room to run, however, as we progress throughout the year.
All right. How are you looking at the demand then? Because last year, India imported record numbers. This year, the demand is lesser. And because we imported so much last year, we're sitting on a huge inventory.
In terms of last year, let's take that for example. Last year was a record year, okay? 1.24 billion ounces of silver of demand. And quite frankly, it's going to be hard this year to get to that level. We're calling for a small decrease, but yet even so, those numbers are still going to be quite strong when you look at a 5-year step back. So it's going to be another good year for silver. And, you know, India led the way last year. India led the way in jewelry demand, silverware demand, investment demand. They had a very strong industrial demand. And while we think there may be a little bit of a drop-off this year, it's still going to be very, very strong.
So when you say that, any numbers that you're putting out there in sense of demand from India this year?
In terms of industrial demand, we're projecting about a 6%, or total demand about a 6% decrease. We think that industrial demand is going to grow by about 4%. We think electronics and electrical will grow by about 3%. And jewelry will probably dip a little bit at maybe 10%, and also silverware. Now, remember, that's coming off a really exceptional 2022.
Michael, you were recently in India, and what do you think that Indians are buying when it comes to silver? Because ETFs seem to be doing quite well. Physical demand is expected to pick up once we get into the festival season, which isn't too far.
We heard some good presentations in India at the inaugural India Silver Conference in Jaipur last weekend. And quite frankly, they are dipping into waters into the ETF. I mean, it's quite phenomenal. It's only been on the market a year, 2 years or so, and it's showing great strength. The physical side, as you mentioned, will begin to pick up again as that season approaches. But quite frankly, the interest in all things silver from an investment, including digital silver, which is rather new, is quite interesting. And I think that the Indians will continue to play an important role in the investment component of the silver complex.
So, Michael, you've told us that physical demand will do well, investment demand will also do well. But what's your sense on the industrial demand now for India and China too?
Absolutely. You know, we're calling for just a 4% increase in industrial demand by the end of this year. And that, of course, is really dependent on what we think is going to happen with electric vehicles, what we think is going to happen with the whole automotive sector, but also in photovoltaics. We think that the PV sector is going to go from about 140 million ounces last year to over 160 million ounces this year. And we think that's going to continue to grow as the years progress. So we're very optimistic about industrial demand for 2023.
Okay. Also requesting some more numbers now, Michael. So what's your sense on the deficit in this year, availability, mining, demand, supply, if you have those calculations at hand?
We think that this year, you know, there'll be maybe a 2% increase in mine supply. And that's primarily due to the fact that some of these projects are coming back online. There's a few new projects, but 2% isn't a real big number. Look, we think that 2023 will be the third year of market deficits. Starting in 2021, 2022, we had a massive deficit of darn near 240 million ounces. And this year, we think that deficit is going to decrease a tad to 141 million ounces. But again, that is a historically high number when you look at the market deficits. And we're firmly convinced that the silver market has entered a new era of market deficits from here on forward.
All right, that's another bullish view coming in for silver. Third year of deficits and demand continuing strong. Michael, as always, thank you so much for joining us. And with that, it's a wrap on this edition of Commodity Champions. Thank you for watching.